Welcome to Multifamily Investor. I'm your host, Andy Hagans. And today we're talking about 1031 exchanges and DSTs, some of my favorite topics in the world of tax advantaged real estate investing. Joining me today is my business partner at WealthChannel and co-founder of the Opportunity Zones database, Jimmy Atkinson. Jimmy, welcome to the show.
Hey, Andy, this is awesome, man. Super excited to be on Multifamily Investor. Let's dive in.
Yeah, and this is a little two-part series on the show where we're going to cover DSTs, Delaware statutory trusts, and then we're going to cover Opportunity Zone funds back-to-back in two back-to-back episodes. Jimmy, I just think you're like the best possible guy to bring on the show to talk about both of these vehicles. I know you have a real passion for tax-advantaged real estate investing, and I know a lot of our listeners are already going to be familiar with DSTs. Of course, in real estate, 1031 exchanges are one of the very most popular strategies to use to grow wealth over time in a tax-advantaged manner. But Jimmy, for any of our audience who aren't familiar with 1031 DSTs, could we just start there? What is a DST? What is a Delaware statutory trust?
Sure. Well, thanks for the kind words. First of all, great intro, Andy. In order to understand what a DST is, it's helpful to at least understand what a 1031 exchange is, first of all. And a lot of your listeners and viewers, Andy, may already have some familiarity with 1031s. It's quite possible that a lot of them have conducted 1031 exchanges, 1031 transactions. But for anyone who isn't aware, a 1031 exchange is essentially a type of real estate transaction in which an investor exits from one real estate investment property or a handful of real estate investment properties, but keep it simple, go one to one, and then purchases a new real estate investment property in something that's called a 1031 exchange or like-kind exchange. And in doing so, if this investor follows the appropriate steps, works with what's known as a qualified intermediator, then that person can defer capital gains taxation on the initial sale of the real estate investment property. So you sell a property, you have a big gain, as long as you within 180 days, find a new property to invest in, then you pay no taxes. A few other hoops you got to jump through, but that's the basics of it. So that's a very direct ownership mechanism by which real estate investment property owners can trade up to new properties. And this investor can kind of daisy chain these over time, whereas he or she can continually 1031 exchange out of one property into another, and then out of that property and into another over the course of his or her investment career. And eventually, upon death of that investor, the basis steps up to fair market value for any heirs. And so there's no capital gains tax ever paid. So it's pretty much deferred forever, basically.
Swap till you drop, baby. That's what we say.
Swap till you drop. Yeah, exactly. Exactly.
Never. So that's the 1031 exchange. And I do think most of our listeners are probably aware of it. But Jimmy, I think you alluded to it already, like why the DST exists. If you think about over the course of your investment career, a lot of real estate professionals or investors, they start out very active. And then as their, investment portfolio, commercial real estate investment portfolio grows over time, as they get older, they tend to want to go passive. Generally, not everybody, but generally, that's a general theme with a lot of investors. They want to go passive. And the 1031 exchange, if you keep exchanging into properties that you directly own and manage, it's a very great tax treatment, of course. But I still, at the end of the day, would have the same problem. I still have to deal with the 3 T's. I exchange into a new multifamily asset. I still have to deal with toilets, tenants, and trash, right? Enter the DST or Delaware Statutory Trust.
Correct. So that is what a DST is. It stands for Delaware Statutory Trust. And essentially, it allows for a 1031 investor to do a 1031 exchange, but do it in passive fashion. So the investor no longer holds the real estate directly, but the investor holds a share or an interest in a Delaware Statutory Trust. And along with maybe dozens, if not hundreds of other investors, that Delaware Statutory Trust holds one or possibly multiple real estate investment properties within its portfolio. It's essentially a fund by another name that is eligible for this 1031 treatment, this very favorable tax treatment. So there's a few benefits to this. One that you've already pointed out, Andy, is that you get to escape from the 3 T's, tenants, toilets, trash, get rid of the headaches of direct property ownership. Another is this investor can now access institutional grade real estate in many cases, whereas if the investor may have previously been dealing with single family rental units or maybe a duplex or maybe a smaller apartment building here or there, this individual investor can now upgrade to something much larger, maybe a 100-unit multifamily building, or maybe several hundred doors worth of multifamily.
So Jimmy, sorry to interject. I mean,
ahead.
what you really mean, like a typical 1031 exchange, I may have an asset that I'm selling for $1 million, conducting a 1031 exchange into another asset that's worth $1 million. Well, if I do this 1031 exchange into a DST, it might be a $40 million asset. It might be a huge, beautiful Class A apartment complex, $40 million. So my $1 million essentially is going to purchase me a 2.5% ownership, but in this asset that I would never be able to afford on my own, right?
Correct. That's exactly right, Andy. And another benefit is that typically these assets are already stabilized and cash flowing, whereas if you're going from one Class C to another Class C apartment building, maybe there's some value add work you have to do, and maybe you got to lease up the building, and you don't have to deal with any of that. With a DST, you're coming into a pretty stable cash flowing situation. There are some drawbacks. You have fractionalized ownership, so you don't control the whole thing. There's some fees, of course, but for a lot of investors, you get rid of a lot of those headaches. You get access to a higher quality, institutional quality, in many cases, type of real estate product, and it starts cash flowing immediately. There's a lot to consider for many high net worth investors who may be sick of the 1031 direct route. Hey, take a look at the Delaware Statutory Trust.
Yeah, and you already mentioned this a little bit, Jimmy, but I want to delve into the details a little bit more. You mentioned that with a DST, you're investing in a stabilized asset, typically already cash flowing, because there are rules, limitations, restrictions, regulations, all of the above around the type of assets that can be owned and operated within a DST, right? So I know in the next episode that you and I record together, we're going to talk about opportunity zone funds, a lot of ground up construction with those. Typically, you're not going to find that in a DST. Also, again, by contrast with an opportunity zone fund or some other types of private equity funds with like a value add strategy, you're not typically looking at a lot of future price appreciation with a DST. There might be some, but that's not really the strategy. You're typically looking at a stabilized asset that's generating income. And I think that is a fit, like for a lot of our audience, high net worth investors, family offices, or even institutional investors. A lot of times they're looking for that capital preservation. They're looking for those stable assets. They're not looking to take a lot of risk. But if you are interested in, going further out on that risk return profile with heavy value add or with ground up construction, you're going to have to look elsewhere outside of the DST market. Is that right?
That's exactly right. Yeah, DSTs by their nature, just the way that the regulations are written, what a DST can be, they're basically core, maybe core plus holdings. They're not value add. They're not ground up construction. They're not heavy rehabilitation. The other side of the spectrum, like you point out, Andy, farther down that risk return side of the spectrum is going to be opportunity zones. There you are going to take on a lot more opportunistic risk. They are substantial improvement of debilitated buildings or it's ground up construction on raw land oftentimes as well. So these two programs do get compared a lot oftentimes, Andy, because they are both tremendous real estate investing programs that carry huge tax advantages, and they are capital gains tax advantages for each of these. But there's pros and cons to each of them, and there's some very key differences that we'll touch on. I think we'll talk about opportunity zones a lot more in the next episode.
Well, I do want to interject briefly though to compare them. I think this is a really important point because we're going to get into some specific DSTs here in a minute.
Mm-hmm.
But I think it's important to say, who this product is for, who this vehicle is for. Of course, always check it with your financial professional, your accountant, your advisor. I'm not an advisor, et cetera, et cetera. But with qualified opportunity funds, opportunity zones program, you can use any type of capital gain from the sale of any asset, including, stocks, bonds, mutual funds, et cetera. Use that capital gain to make an investment into an opportunity zone fund. So that's one of the great advantages of that tax advantage program. With a DST, it needs to be a 1031 exchange where you are selling a real estate asset. So if you don't have a capital gain from a real estate asset, you're not going to be able to use a DST. You're not going to be able to invest in a DST. Essentially, you don't qualify. You can't take advantage of this. So I think that's an important disclaimer that this is a very, very powerful program. But if you don't have a capital gain, still listen to the rest of this episode. It may come into play later in your investment career, but it's not going to apply to you, right?
Yeah, that's exactly right. I mean, that's what I tell investors who ask me the differences between the two programs. I ask them, well, first of all, what type of gain do you have? And you have to have a gain with either one of these programs. If you have a gain from the sale of real estate, then really both avenues are open to you. If your gain is from the sale of a privately held business or your stock portfolio or collectible, or we had a lot of low cost basis, high appreciation crypto gains a couple years ago, Andy, that's kind of since fallen by the wayside a little bit, but we had a lot of investors like that early on. If you have a non-real estate gain, whatever it's from, you really can't do a like kind exchange into a 1031 or a DST. It has to be an opportunity zone if you're going to take advantage of one of these two programs. That's right, Andy.
So I do know a lot of family offices, a lot of high net worth investors are sitting on capital gains from investment real estate, right? Real estate, very, very popular asset class among high net worth investors, among LPs of all kinds. So now, presuming I have a potential capital gain, with an asset that I own, I want to do a 1031 exchange, but I want to go passive. What are my options, Jimmy? What are the range of assets that are available in the market? How many assets might be available at any given time? These DSTs, they open and close. I remember a year ago or maybe 18 months ago, they would open and close very, very quickly, right? Because a lot of sellers there were just a ton of demand for DSTs. Has the market settled down at all since a year or two ago?
Yeah, the market's changed a lot. 2 years ago, Andy, you're right. DST products were flying off the shelves. I mean, you would take a look at the marketplace one day, and then if you came back 2 weeks later, it might be completely different types of DST products that would be available to you, because they really did have a very small, or short, I should say, shelf life. That has changed a lot. We've had new players enter the market, so we have a lot more DST supply. And also, we've had a lot of pullback in the real estate transaction market. So the marketplace has slowed down quite a bit, and there's more supply. So these products stay on the shelf a little bit while longer. So it's kind of easier for investors to assess their needs, at least as we sit here recording this in August of 2023.
Jimmy, I want to clarify to everybody. I mean, it still is a bull market for DSTs. This is still a growing, very popular product segment. It's just not quite as crazy as it was 2 years ago, right? So
if you're a high net worth investor, this is a good thing, I think, because you don't have to feel like you're in such a rush. It's the folks on the other side, the DST issuers, who are having trouble filling some of these, closing some of these DSTs quickly. They're still closing them, but it just takes, it might take 90 days instead of 14 days like it did a couple years ago.
I might say it's a more normal, more healthy market in a lot of ways, right. Jimmy. To me, it's just a little breath of fresh air. But that being said, would you mind providing me with some specific multifamily DST examples? Like, let's say I have $1 million to invest. What are some of the investment minimums? What are some of the different assets available, different sponsors? Walk me through some examples.
Yeah, so there's a few dozen sponsors that issue these Delaware statutory trusts. Some of the big names are Capital Square, Cantor Fitzgerald, Griffin, Pasco, Inland. We've had some of those CEOs and CFOs on our podcast, Andy, over the years. Yep. So we're friendly with with the vast majority of those issuers I just listed. There's dozens of others.
I'm going to try and get Inland on. I'm going to try and get Inland on the show. I'm going to try and get Capital Square on the shows. A lot of these names, I'm going to try and get them on the show here. But, Jimmy, let's talk about some of their products, though. Sometimes it's easier to talk about their products when the sponsors aren't here, right? So
yeah, absolutely.
Tell me about some of these DSTs.
So by the way, a couple of websites that I like to use to look at the DST marketplace is one of them is Realized 1031 at realized1031.com. You kind of have to sign up there to get into their marketplace, but they have a really good marketplace. And then another one is KPI1031.com from K Properties. But sometimes you can just go direct to the sponsor. So right now I'm on Capital Square's website, and if you click on their open offerings, and then you can filter by DST. And by the way, they have opportunity zone funds as well. But if you filter by DST, they have a handful of different multifamily properties that they sell under the DSTs. I think most, if not all, of their DSTs are single asset. It looks like they have a couple of multi-assets, but I'm just going to click this one here that's called Tapestry West Apartments, Richmond, Virginia. So this is, 100 and something unit multifamily complex. It's one asset. It's a very large asset that looks like it takes up close to a full city block in Richmond, Virginia. So as an investor, if you do a 1030, if you're exiting from one real estate investment property that you own and you sell it, then you have a certain amount of time. There's a 45-day identification period, and then overall there's a 180-day timeline that you have to roll over the proceeds from that sale into either a 1031 exchange directly or into a Delaware statutory trust like this one from Capital Square, this Tapestry West Apartments in Richmond, Virginia. You get on the phone with Capital Square. They would probably hook you up with a QI, a qualified intermediary, who can help you complete the transaction. The investors, it's important to know, investors can't complete these transactions directly themselves. It's a little bit more complex than, clicking a couple of mouse buttons and sending in a wire or writing a check. All of these transactions, whether you do a direct 1031 exchange or a Delaware statutory trust, passive investment has to be conducted through basically a special type of financial advisor or broker that's called a qualified intermediary. Oftentimes, industry insiders, other investors who are familiar with this process might refer to that as a QI. Same thing. Just going back here, by the way, they have several multifamily deals. Capital Square does, but one of my favorite ones is they have some property that they are leasing to the Las Vegas Raiders. It's what they call the zero coupon Las Vegas training facility. So they actually own the training facility where the Las Vegas Raiders practice. And I think they rent it back to them essentially. And it's structured as a DST. So if you're a DST investor, if you're a football fan, maybe you're a Raiders fan, it's kind of cool. You can partially own or have fractional ownership in the Las Vegas Raiders headquarters in Henderson, Nevada, just outside of Las Vegas. And then they've got, a handful of other really cool multifamily buildings.
Jimmy, are there DST offerings like from Capital Square? Are they mostly multifamily? Like how prevalent? If I'm out browsing DSTs from Inland, Capital Square, Cantor Fitzgerald, all these companies you mentioned, are most of them multifamily, or a few of them how prevalent is the multifamily sector in the DST world? Yeah,
good question. Yeah, no, the vast majority of them are multifamily. I don't know the exact percentage, and those figures kind of change all the time, but I would hazard to guess that probably 2/3 of all of the DSTs out there are multifamily, or at least have some sort of multifamily component to them. Okay. I'm just kind of looking through this portfolio that's at Capital Square, and yeah, the only DST they have that isn't multifamily, it looks like currently available, is that Las Vegas Raiders training facility. I'm going to look now at K Properties Investments, because they have a marketplace where you can see a lot of different DSTs that are available. They do have some other property types that are common in DSTs are, well, office used to be, but office has kind of fallen by the wayside. Multifamily is definitely the 800-pound gorilla in the room. You're not going to get a lot of NFL training facilities. That's kind of a unique one that I wanted to point out because I think it's really cool. Medical buildings are actually one of a pretty big sector. And I
Because
think
they're
the reason for that
stable,
is,
Jimmy. I mean, Jimmy, anything that's stable like
yeah,
that,
it's stable. You always, there's always going to be a need for medical buildings. It's unlike,
very long leases. That's not like they have to lease lease renewal every year or something. Like a lot of these properties have 10-year leases, or who knows how long the
yeah,
leases are.
correct, Andy. And the other thing is, as a retail investor, maybe you're worth $5 million, $10 million. Maybe you're worth $25 million. It's kind of hard for you to directly own a medical building, right? But
Mm-hmm.
if you go into it with a few hundred other investors, you can have fractional ownership in $100 million or $250 million medical building or medical campus. So listed on this marketplace here, there's a handful of medical DSTs. Here's a pharmacy DST which has a single tenant net lease with Walgreens. So that's another common thing, by the way, Andy, is these types of triple net leases or single tenant net leases are quite common with these types of funds too. You can find those with stores like Dollar General or Walgreens or CVS or those types of
Yeah,
properties.
and Jimmy, I know there's a lot of crossover, between high net worth investors who invest in multifamily, also doing triple net leases or some of these other sectors you mentioned. But I have to say, I mean, I do think that the DST, the structure of the DST, the goal of the DST, it really dovetails perfectly with multifamily, right? With the characteristics of multifamily, with being that portfolio diversifier, providing that stable income, favorable tax treatment. To me, multifamily and DSTs are a match made in heaven, provided that, you do have that capital gain from the sale of real estate. That makes it so you qualify. I will say there's a lot to know about DSTs, right? Like I think you've done a really good job of giving us a crash course, Jimmy, but there's a lot more to know. And so I got to plug your new show for our audience. You didn't plug it yet, by the way. You're very, very humble. But like I said, Jimmy is really one of the foremost authorities on tax advantage real estate investing. He's run an Opportunity Zones podcast for a long time. Very, very well recognized podcast there. We'll talk about that more in our next episode here. But you've recently launched a podcast all about Delaware statutory trusts called DST Investor. Is that right, Jimmy?
That's right, Andy. DST Investor is one of the newest in the big new batch of podcasts that we've released at WealthChannel. And on the show, I'm going to be showing high net worth investors how they can grow their wealth with Delaware statutory trusts, with DSTs. And we're going to highlight every couple of weeks, we're going to highlight a different DST that's open and available to investors, and we'll cover different strategies. We might have some different sector spotlights, and I'll have a lot of different guests on, and I might try to reach out to a lot of the same guests that are going to be on your show as well, Andy. So I'm looking forward to that. And investors can learn more by heading over to the DST database website at dstdatabase.com. That's where they can go figure out how to follow the show on YouTube or Spotify or Apple Podcasts.
Yeah, and Jimmy, I got to say, I think the show was overdue. I mean, I'm not like lecturing you, like, hey, why didn't you launch this thing a year ago? But I just mean, we talked about this market. It was like white hot 2 years ago, the DST market. And it's not as crazy as it was, and to my point, I think it is better, more healthy now, right? It's still growing though. Like to me, it still is this growing market. There's a ton of interest. You see more and more LPs coming into the fold, right? We have, the baby boomer generation. God bless them. They've those that were involved in real estate have done very well for themselves. A lot of them are wanting to be passive LPs as they enter retirement or into retirement, and so that's one driving force, growing this DST space. I also just think it's a good product, right? It's very clearly defined who it's for, what it's for. The tax advantages are, massive. The fact that you can still enjoy all of those benefits of a 1031 exchange while being a limited partner, that's huge. So the fact that the space is growing so quickly, to me, it really needs that podcast, that media presence covering it. So I'm really excited about DST Investor. By the way, everybody,
I'm excited about it too, Andy. I think you're right. I think currently where we sit here, August 2023, we're in a little bit of a dip. I think we have some market headwinds or some macroeconomic headwinds that the industry is dealing with, but long term, there are so many structural tailwinds that I think are really going to lift this type of investment vehicle over the next 10, 20 years and beyond.
Totally. Well, don't jump on my last question, Jimmy. We're almost short on time, but I was going to, because you have this new show, you're covering the space. Where do you see this going? I mean, you see, like you said, it's in a little bit of a lull, but are there any trends or anything investors, could have to look forward to or should be keeping an eye on in the next several years in the DST space?
Well, I might zoom out and just look at real estate in general, the big real estate picture. Real estate transactions are way down this year. Interest rates are way up. It's tough to find a deal. It's tough if you're a seller to find a buyer who's willing to meet you at the price that you want. I think this is kind of what I stepped on your question, Andy, with my with my answer a minute ago. But I do think we are facing a little bit of some market headwinds, some macroeconomic headwinds currently. I do think that this clears up. I don't know if it clears up in the next 3 months or the next 6 months or the next 12 months, maybe the next 24 months. Long term, I look out 5, 10, 20 years. I think there's going to be huge demand for this type of product because, as you mentioned, structurally speaking, there's a lot of tailwinds here. With baby boomers retiring, they hold huge amounts of assets in real estate investment portfolios, and they're going to be divesting of those portfolios over the next decade or so. Might not happen right away, but long term, I really like this niche that we've picked here, tax efficient real estate investing with opportunity zones and with what we're talking about today, Delaware statutory trust 1031 exchanges. I think it's going to be, once we kind of pull out of the doldrums here, I think it's going to take off and it won't stop running for quite a while.
She's a long-term bull market, folks. I think that's what I'm hearing. And I want to plug Jimmy's new show one more time. If you open up Apple Podcasts or Spotify, just search DST Investor and you will see Jimmy's smiling face on the cover art. You can follow the show and get new episodes as he releases them. Jimmy, thanks again for joining the show today.
Thanks, Andy.